Welcome to another episode of the Closed Podcast. I'm Lee Bergstein. Today, really excited to have with us Ferdinando Monte. He's an associate professor of economics at Georgetown University. He researches international trade, regional and urban economics. Today, we're going to be talking about a topic that is unfortunately near and dear to everybody's hearts these days, tariffs. And particularly because it's a real estate podcast, tariffs impact on real estate in metropolitan cities. Obviously, we're mostly talking about New York City here, but I think a lot of the stuff we'll talk about will touch on the country. So, Fernando, thanks for being here.
Well, thank you for having me, Lee. Thank you.
And everybody wants to talk about tariffs these days, so I'm sure this will be a much listened to podcast. But I guess in light of that, why don't we start here? Because I do think that while many people, broadly speaking, understand how tariffs work, a lot of people listening basically just rely on what they either hear in the news or they see on social media. And I feel like there's a divide in knowledge, as there are in so many things, between the left and the right as to what tariffs actually are and the impact they have on the broader economy.
Right.
You just distilling it down to its most crude version, the left seems to say tariffs are a tax that are passed on to the consumer. Most of the language from the right is it's meant to. I don't even know what the language on the right is, but most language on the right is that it works the other way, and ultimately it's good for the broader economy, and it's this money that the United States is being deprived of, and should be returned in some fashion. So,
right.
What's a good kind of 2-minute overview of tariffs? How should people listening to this look at them, think about them, and what's the real impact on the economy?
Yeah, I guess the simple way in which you want to think about tariffs is that they are basically a tax that is paid when a good is imported into the country, right? And so, on one side, when you have a tax, you discourage the demand of that good, and you raise its price. And so prices are going to be higher, and to some extent are going to be passed up to consumers. The other effect of that is going to be that consumers are going to shift towards goods that are now relatively cheaper, I would say. So perhaps what people have in mind is that this is going to increase the demand for products that come from U.S. producers, because those products are not impacted as directly by the tariffs themselves.
The dollar tree is going to be very busy for the foreseeable future.
It might be. Now, of course, even those that produce goods in the United States do use, inputs, materials, goods that are imported from outside. So to some extent, their cost is going to increase too, right? And so, I mean, the final impact is, as we'll talk about, I think later, it's going to really depend on which industry you are, which area, which city you are, what is your activity. But I guess that's a way of sort of making a catalog of the positive effects and the negative effects of the tariffs. That they're an increasing cost, they'll shift demand towards products that are produced in the United States. And so the question is, by how much costs are going to increase, and who are the beneficiaries of this on the U.S. side of production?
Yeah, I mean, you could look at it, I guess, just through a basic economics 101 lens, right? It's just supply and demand.
And you want to think about where supply shifts and where demand shifts, and that's true in general, and that's probably true. That's also true in the real estate case, of course.
Yeah, so that's a good segue. Certainly, I didn't. When I heard about tariffs, you think about how is it going to impact your business, right? As a law firm, consumers, how's it going to impact pocketbooks? How's it going to impact willingness to do deals? Impact willingness to bring lawsuits? It didn't really occur to me that it might have an impact actually on real estate. But can you talk through how
Sure.
2005 view of how it might impact the real estate market?
Sure. So I mean, it's you want to use the same tools, essentially the same concepts, right? So, what's going to determine rents and what's going to determine the demand, the use of space? Well, it's going to be the balance between the supply of space and the demand of space, right? So on the supply side, you want to ask questions like how expensive is going to be to supply, to construct new space, right? To offer new space, or how expensive is going to be to keep up with depreciation in buildings. And on the demand side, you will ask questions about how much space are people, are companies willing to use at a particular level of rent, right? And so tariffs is going to affect the supply of new space because they impact the construction costs. And because, I mean, in the current environment, along with tariffs, we have uncertainty about tariffs. And so that's going to impact, the new supply just because of the increase in uncertainty. And we could talk a little bit about that if you want as well. On the demand side, businesses are going to be impacted because to some extent they are facing higher costs. And if they're facing higher costs, to some extent, they'll pass these costs to consumers in the form of higher prices, right? That typically has as a consequence that demand goes down. So the revenues of these businesses goes down. And when these revenues of the businesses go down, they have some costs which are variable, the materials, the wage that they pay to the workers, but they have some costs that are fixed, which is the rents, right? And so if the revenues go down, the next time that you have a rental renewal, what you're going to do is you're going to ask for concessions, and that's one way in which the tariffs are going to affect the level of rents, right? So broadly speaking, tariffs are going to impact the demand, they're going to impact the supply. Again, what is going to be the final impact depends on, I guess, on the particular sector you're thinking about, the particular location you're thinking about, and so that sort of merits its own discussion.
Yeah, I mean, costs and demand are variables that businesses, I guess, don't really have control over, but if fixed costs like office space, retail space, they do have a lot more control over. So it sounds like the concern is, at least a concern for the market, businesses might look first to those expenses that they have control over before to try to deal with this issue and retain profitability before they turn to issues that they have less control over. Is that a fair way of looking at it?
I think that's a fair way of looking at it. When revenues go down because consumers are going to spend less on particular services, on particular goods, the consequence of that is that businesses will see that they have less revenues, and they'll have to make up for these on the cost side somehow, right? And you're right. On some things, firms have little control over, and on some things they have more control over, and they'll go first with the item that they have more control over. Of course,
I'm trying to dip back into my high school economics lexicon. Yeah. I'm struggling, so you have to bear with me.
No, sure.
So, two sectors jump to mind because we do a lot on this podcast about new housing, the housing deficit in New York, affordable housing, and then office space and the impact of COVID and the pandemic on the office market in New York. And it feels like for different reasons, this is going to have an impact on both of those spaces. I guess let's talk about housing first.
Sure.
When you talk about construction costs going up, there are already in New York City so many challenges to new construction, be it property taxes, cost of labor, and certain legislation that has to deal with increasing labor costs. It sounds like this is another brick in the wall that's being built that might prevent residential construction. Is that a concern? Is that something you've heard about?
So yeah. So I'm not an expert in construction, so I cannot tell you by how much costs are going to increase. I read an article a couple of weeks ago about an Urban Land magazine that was saying that the cost of materials range between 40 and 60% of the total costs of direct cost of building. And so in that sense, many of these materials like cement and steel, sometimes lumber, they are imported, right? And so tariffs on these inputs are going to be translated into higher cost and perhaps higher prices, because I as far as I understand, the construction industry it's a pretty competitive one, which means they have little margins to cut,
Right.
right? And so so the only option is to raise the price, right? That the customer pays.
Right.
So that is, I think, a concern. Um, which kind of supply, which kind of housing is going to be impacted more? I wouldn't say, because that, again, that depends on the cost structure of the different types of housing that you're looking at. And I'm not very familiar with that, but I think that's an interesting question, because that is going to tell you, where supply is going to grow less, which means everything else equal, where rents are going to grow more, right? So I think that's an interesting question. I don't have the answer to that, but that's worth thinking about, because it's, when you underwrite a project, rent growth is one of the things that you think about. It's probably the first thing you think about, right? And so that's going to have an impact across different types of construction, for sure.
I haven't studied this, but based on some of the conversations we've had in this podcast, it
Uh-huh.
feels like this just is another obstacle for developers who are already somewhat skeptical about the future of residential new construction in New York. Again, for a myriad of reasons.
Yeah,
Uh,
yeah. So when you have higher costs, you're going to reduce the supply, right? So if at a given level of forecasted rent, you think that a project is worthwhile and the costs go up, some of those projects are not going to be worthwhile anymore,
and
right?
this is partly not just due to supply issues. This is due to forecasting the rental market and forecasting the disposable income that people have. And
Yeah, exactly. So that's the other issue about uncertainty, right? So there is so when you execute on an investment, you're giving up the option of waiting and deciding with more information, right? And so when uncertainty goes up, one of the things that happen is that you tend to wait a little more.
yeah.
But waiting is essentially another way of restricting supply,
Hmm.
right? And so everything else equal, project that would have penciled in perhaps now are delayed just because there is a little bit more of uncertainty on the on the revenue side.
And it follows the whole vertical integration of how this works, right? From the lender to the developer to the contractor. There's higher risk because there's higher uncertainty at
That's right.
every level.
Yeah, I would say so. I would say so.
So let's talk about enough bad news about the residential the construction market in New York. Let's talk about the office market. And I know you've written in the past also about the pandemic's impact on
Yeah.
the office market and work from home. How does this development, the development of tariffs, kind of interplay with that? And what do you think is the broader what's the impact in the broader outlook for the office market in kind of major metropolitan
I
cities?
see. So I what I would say is that industries that use offices, as most of the industries, will face a little bit higher costs, right,
Mhm.
because of the tariffs. And if you want, we can talk about how that happens actually, right, because perhaps that gives a little more concrete examples.
Yeah, yeah. How does let's deviate. How does that happen so we don't forget?
Oh no, well, so I mean, to give like a real world example, right? So suppose we're talking about a U.S. manufacturer of smart lighting systems,
Hmm.
right? Okay, so
It
then
sounds very specific. So you must have.
yeah, no, no, no. It's just something. I thought a little bit about it because I wanted to give sort of something that is concrete, right? And I don't have any particular producer in mind, if that's what you're asking. So they're going to import some inputs from abroad, right? Because to build these things, maybe sensors, maybe circuits, and now these inputs are more expensive, so their costs go up, and to some extent, their price has to go up, right? Now, um, those lighting systems are used by consumers, and some of them might have thought about buying them, and now they keep their own traditional switches, right? And so they go less to the stores. some of those inputs are used, some of those systems are used by businesses, right? Maybe are used by restaurants, by museums, right? And so they will face higher costs as well, right? And so, they'll have to decide, do I want to use it? Do I want to pass out to consumers? Do I want to buy them or not? In fact, those things are used even in sectors that are not used by consumers. Maybe it's manufacturers, right? So all the costs creep up a little bit, and these tariffs are unique in that it's an increase of tariffs across the board. Now it's hard to keep up with the news, but as far as I understand, so far we're talking about 10% tariffs for basically all the countries, right? So all the costs creep up a little bit, which means all the businesses are facing higher cost, and all the consumers are facing, to some extent, higher prices, right? So that's the way in which this increase in tariffs sort of translates into a real effect, right? So all the businesses are facing a little bit higher costs. Consumers are facing higher prices. They're going to have to cut on expenditure, right? And as they cut on expenditure, that means businesses are going to have lower revenues. And when the rent comes up for renewal, they're going to ask for concessions because the cost is fixed, revenues are lower. If you were breaking even before, you'll need lower rent, right? If you were barely breaking even, then you'll try to renegotiate a little bit. So that's the way in which this sort of creeps into the real estate market. One way in which this creeps into the real estate market. To get back to your original question about offices, that's basically the story, right? So costs are up, demand might be down a little bit. So renegotiation might be one of the things that happens. Office is particular in that because now we've always had it, but it's more used now. This remote work option, one way in which you can reduce the cost is in fact to give up the space, right, and do a little more of remote work. Allow workers to do a little more remote work because that cuts down
or downsize.
exactly, and that's now a margin that is more used than it was in the past, right? So for the office market in particular, this might be a margin of adjustment that perhaps is not there for retail, right?
Yeah,
Or not to the same extent.
and it's actually your very specific light example triggered something in my mind, which is you think about the office market and you're like, okay, well, how does the tariffs connect to office space, and you just kind of laid that out pretty well. But there are additional things too, right? So like you take space. Sometimes you are performing a build out. It's not a space that your existing company can use. So you need to perform construction. It already takes a very long time for that to get
Yes,
done. And now it sounds like it will take more time and be more expensive. And there's office furniture, there's office supplies, there's all this stuff that comes along with this. You're not just taking a white box; you have to kind of turn it into a usable space.
that is
And
right.
and many of the things that you have to do to turn it from a white box to a usable space involves importing product, furniture, etc.
Right. Either importing directly or using or buying from US producers things that use imported inputs. So to
Yeah.
some extent, all the costs are going to go up a little bit, right? So that's the downside of this.
And this this is not even directly related to real estate, but just a question that piques my curiosity. You hear a lot about how one of the talking points is this is going to really help domestic producers of goods. Isn't there going to be an incentive for domestic producers to also raise prices because now their competition is so expensive? Why would they keep their prices the same? They're still going to be very competitive with companies that rely on international production, and it's a good opportunity for, I don't know, price gouge a little bit,
Yeah.
increase.
Well, I mean, I think the first concern you want to so let me take a step back. So when you put a tariff that protects the producers of U.S. lighting systems, they'll have an increased demand,
Yeah.
right? So the demand for the inputs they use, including the space that they use, that demand is going to go up,
Hmm.
right? So if you want to find a silver lining in the real estate in all of this, that's what it's going to be.
Yeah.
Right now, this is just a partial silver lining because these producers will still use um, somehow inputs that are imported, or will still use things that use imports that are imported, right? So for them, the cost is going to go up as well. So uh, uh, I can see that there is an increase in demand because consumers are switching to them, but they also have an increase in cost because they still use things that are imported,
Hmm.
right? So that's the silver lining. Is not a full silver lining. The question about the price gouging, it really depends on competition. I mean, if as long as there's many producers in US, um, you cannot raise the price too much above the competition
Hmm.
because otherwise you're still missing on the market. So that really depends on the competitive structure of the particular industry you're looking at.
Yeah. Um, we talked a little bit about office and residential. We touched slightly on retail and hospitality industries. Are they facing the same types of challenges, or is that asset class going to be facing a slightly different array of challenges based on tariffs?
So what I would say is that, so when you think about retail, the you want to think, so the I mean, on the supply of space we've already discussed, right? So the supply might be lower because of a couple of reasons. So everything else equal, that's going to keep up the rents,
Right.
right? On the demand side, it really depends on how consumer expenditure behaves, right? And so there's maybe two, three things you want to think about when you think about consumer expenditure. One is how the prices of the things that these retailers sell is going to behave. And we sort of already said that, broadly speaking, these prices are going to go up. And so that means everything else equal, revenues are going to be lower. That means they're going to ask for concessions when the time comes for
Right.
renewing the rent. The other thing that happens is the other effect on consumer expenditure is going to come through wages, right? Because all the economy is going to slow down a little bit, and so everything else equal, firms are going to try to keep wage growth in check, and the consequence of that is that consumer expenditure is going to be lower a little bit, right?
Right.
Everything else equal. And the third piece of it is that there is evidence that consumer expenditure, especially on services or retail, we might think about, is tied to some extent to the movements in the stock market. And one thing that has happened as a consequence of these tariff uncertainties is that the stock market did fall significantly, right? And so there is this link that has been documented in the literature between the value of the stock market and consumer expenditure on restaurants, let's say, or museums. Um, and so, to the extent that this link is operational, or to the extent that consumer expenditure in particular places, maybe like New York, is tied to the value of the stock market more than in other places, that is going to have a negative impact on consumer expenditure, and that means on demand for space in retail, and that means on rents,
Yeah,
right?
it's emotional and mental, though, right? Because it's tied to someone looking at a computer at their 401k and saying, "Oh, I made $100,000 in the last month. I'm willing to spend more money on Broadway this week." So it's tied to the emotional component of understanding that the market is going up. And maybe that's wrong, but it would seem to me that who knows if the market's going up or down any given week for the
No, no,
next.
no. For now, exactly. So for now, things are so volatile that
Yeah,
um, it's uncertainty, right? So that delays expenditure, that delays investment, and
yeah.
and and
The question was going to be like, are we? Is this a non? Can we even rely on that traditional way of looking at a direct correlation between the market going up and more spending? Because I think the calculus for many people has changed. Where well, maybe it's going up this week or this month, but who knows what's going to happen 90 days from now or
oh,
180.
no, no, no. I agree with that, and that sort of brings us back on on the issue of uncertainty as we were discussing, right? So even if the stock market was at the same level, I guess it's reasonable to say that if uncertainty goes up, then people hold on to their money a little more.
Yeah. Yeah. Similar to the developers who sit in the sidelines when there's uncertainty, right? The
That's
consumers
right.